These are three concurrent structured products being issued by Investec Bank that I have reviewed. I'm focusing on number 1, the ZAR Eurostoxx 50 Auto Call. I just feel, in my opinion, number 2 and 3 have the potential of rand appreciation eventually affecting the return, so I'm focusing on number 1. Auto calls are a type of structured product which may pay out earlier than the term if a predefined condition is met. So although the term to maturity may be 5 years, it could pay out after year 1 if a particular condition is met. In terms of capital protection, it's 100% capital protection with a 40% potential downside, still resulting in a capital protection scenario. Auto calls are popular as they offer a defined return even in unpredictable market conditions. Further, these returns have memory, meaning that they are rolled up as enhanced returns. If they are not earned in a particular year, they may be earned cumulatively in the 2nd, 3rd, 4th or 5th years. This is an auto call style of structured product, which means it could auto mature prior to the full investment term. The call dates 1, 2, 3, 4 and 5 represent the anniversary dates of the initial launch of the product. At the first anniversary date, which is call date 1, the Eurostoxx index is compared to the initial index level at launch. If that index level is higher, a coupon rate of 20% is paid with the capital back after year 1. So in other words, the product has auto matured or auto called. Should the index be below the initial starting index level, the product rolls into the 2nd year. The same process takes place at the end of the 2nd year, and if the index level is higher than initial index level, then you are paid the 20% for the 2nd year, as well as the roll up of the first year's 20%, which means 40% plus your capital back. In other words, in this case, it would have auto called at end of year 2. So in other words, you have 5 bites at the cherry. If at end of year 5, it still has not auto called and it's still below the initial level, but has not exceeded 40% below the initial level, you will get your capital back. In other words, there's a downside protection of minus 40% on the Eurostoxx index, which is a healthy downside buffer. The Eurostoxx 50 is less tech heavy than the S&P 500 and is not anywhere near its all-time highs. We feel that this represents more value compared to the S&P 500. The S&P 500 is at its all-time highs. The Eurostoxx 50 has moved sideways for many years and is well off its all-time highs. The most basic measure of the valuation of a market is the PE ratio. In this case, the Eurostoxx index is roughly at its long-term average, meaning neither undervalued nor overvalued. This means that it increases the probability of the index exceeding this initial level on those various auto call dates. Embedded in the coupon rate of 20% is the forward curve indicating the depreciation of the rand against the euro over the next 5 years as being 46% over the projected 5-year term. To obtain some sense of the viability of the auto call structure, back testing is used as a method to simulate the returns since 1999. The simulation indicates that this auto call structure would have paid out its investor with the returns 84% of the time. In the other occasions, 11% of the time capital would have been returned and only 6% of time would have resulted in capital loss. Backtesting can never be relied on 100% to indicate what would happen in the future, but this simulation does indicate that those wanting to enter the markets have the odds in their favor in terms of positive returns. This structured product is going to be launched as a listed share on the Johannesburg Stock Exchange, and all distribution, listing costs, JSE costs, and licensing costs are included within the product and therefore does not affect the return of the investor. The tax implications of the product will depend on the intentions and personal circumstances of every investor and should be discussed with the tax advisor in this regard. Every structured product bears two types of risks: market risk and credit risk. Credit risk refers to the risk of default by the bank that's issuing the particular structured product. Although Investec is structuring this product, the credit reference entity is Standard Chartered Bank. The credit rating of Standard Chartered Bank can be reviewed by clicking on the link below. Should you be interested in the product and whether it's relevant for your particular financial situation, please contact us timelessly as the closing date is imminent. Thank you.